Did you know that some of the greatest fortunes in history were built during recessions? While most people panic and pull their money out of the market, the smartest investors see downturns as golden opportunities. If you play your cards right, a recession could be the best time to invest, when assets are undervalued and the competition is scared. By the end of this video, you'll know exactly how to protect your wealth and even profit during an economic downturn. But before we talk about strategies, let's break down a crucial question. Why do recessions create massive investment opportunities? Recessions are periods of economic contraction. Job losses rise, businesses slow down, and stock prices plummet. The natural reaction? Fear. Investors rush to sell, cashing out at the worst possible moment. But here's the reality. Market crashes don't destroy wealth. They transfer it. When people panic and sell, smart investors buy at a discount. Think about 2008. Amazon, Apple, and Netflix were trading at fractions of their current prices. Those who bought in then made fortunes. Warren Buffett famously says, "Be fearful when others are greedy, and greedy when others are fearful." In a recession, fear creates rare buying opportunities. The key is knowing what to buy and when. Before going all in on opportunities, the first step is defense. You don't want to just survive a recession, you want to come out stronger. Holding some cash on the side is a power move. Normally, too much cash means losing value to inflation, but in a recession, it gives you flexibility. You can seize opportunities when assets are at their lowest. Not all industries suffer equally. Healthcare, utilities, and consumer staples tend to perform better because people still need food, electricity, and medicine. Companies with strong balance sheets and consistent dividends act as a shield. Even in downturns, they provide income, reducing risk. The mistake most people make is panicking and selling at the bottom. Instead, this is the time to reposition yourself for the next bull market. In the next part, we'll go deep into the best recession-proof investments and how to find assets that will explode in value once the economy recovers. Stay with me, because missing these opportunities could cost you years of potential gains. Some investments collapse during a recession, but others not only survive, they thrive. Knowing where to put your money when the economy is struggling can make the difference between watching your portfolio shrink and setting yourself up for massive gains when the market recovers. The key is to focus on assets that remain strong even in downturns. Companies that provide essential goods and services, things people can't live without, are historically more stable. Think of healthcare, consumer staples, and utilities. No matter how bad the economy gets, people still buy medicine, pay their electricity bills, and purchase everyday essentials. These industries tend to outperform when everything else is falling apart. Then there are dividend stocks, companies that consistently pay shareholders, even in tough times. These stocks act as a cushion, providing steady income while the market is down. The best part? When prices drop, dividend yields increase, meaning you can buy solid companies at a discount while locking in higher returns. This strategy is what keeps long-term investors profitable, even during the worst market conditions. Instead of focusing on price movements, dividend investors focus on cash flow, allowing them to reinvest at lower prices and accelerate wealth accumulation. The most successful investors don't just look at which stocks are cheap, they look at which businesses have the strongest fundamentals to withstand economic storms. But stocks aren't the only opportunity. Real assets like gold have historically served as safe havens. When inflation rises or uncertainty grips the markets, gold tends to hold its value. Unlike stocks, gold doesn't rely on company earnings or economic growth. It moves based on investor sentiment and monetary policy. Central banks increase gold reserves during uncertain times, and wealthy investors allocate more capital to it when the dollar weakens. While gold doesn't generate cash flow like stocks or real estate, it can be a powerful hedge against currency devaluation and financial crises. And it's not just about precious metals. Real estate in strong locations can be a powerful hedge, offering both cash flow and appreciation once the market rebounds. The trick is to buy when others are desperate to sell. In every recession, people panic sell properties, either because they need liquidity or because they fear further price declines. Smart investors recognize these moments as opportunities to acquire valuable assets at significant discounts. Rental properties in high-demand areas can generate steady income even in a downturn, and when the economy recovers, property values tend to surge. Real estate investment trust REITs can also be a great way to get exposure to real estate without directly managing properties. Another place where smart investors turn is bonds, particularly high-quality government and corporate bonds. When stocks crash, bond prices often rise, making them a defensive tool to balance your portfolio. In a crisis, capital preservation is just as important as growth. Government bonds, especially from stable economies, provide a reliable income stream and serve as a hedge against volatility. Corporate bonds from financially strong companies offer higher yields than government debt and can provide attractive returns when selected carefully. And let's not forget one of the most overlooked assets, your own skills and knowledge. Investing in yourself during a recession can be more valuable than any stock or bond. When the economy is down, job markets shift, new industries emerge, and those who are prepared take advantage. Learning a new high-value skill or improving your financial literacy gives you a long-term advantage, no matter what the market does. Many people wait for the economy to recover before taking action, but those who upskill during downturns position themselves ahead of the curve. Whether it's mastering a new technology, starting a side business, or improving your investment strategies, this is the time to build a foundation for future financial independence. Recessions are wealth-building opportunities for those who know where to look. But timing is everything. Jumping into the market too soon can lead to losses, while waiting too long can mean missing out on the biggest gains. Understanding market cycles, investor sentiment, and key economic indicators can help you make smarter decisions. Now we'll break down exactly when to buy, how to spot market bottoms, and the mistakes that could cost you everything if you're not careful. Catching the right moment to invest during a recession is what separates those who simply survive from those who come out far wealthier. Timing the market perfectly is impossible, but understanding key indicators can help you make better decisions and avoid costly mistakes. One of the biggest errors investors make is trying to predict the exact bottom. Markets don't just fall in a straight line and suddenly recover. Instead, they go through cycles of fear, temporary optimism, and further declines before finally stabilizing. This is why dollar-cost averaging, investing consistently over time, can be a powerful strategy. Rather than trying to buy at the absolute lowest point, you spread your investments out, reducing risk and increasing your exposure to long-term recovery. Watching economic indicators can also provide clues. When unemployment is rising, corporate earnings are falling, and consumer confidence is low, the market often hasn't found its bottom yet. Historically, stocks tend to start recovering before the broader economy improves. When headlines are still filled with doom and gloom but stock prices begin stabilizing, it often signals that the worst is over. The key is to act before everyone else realizes the tide is turning. Another sign that markets may be near their bottom is when fear reaches extreme levels. The best investors pay attention to investor sentiment, not just numbers. When financial news is overwhelmingly negative, when people around you are saying they'll never invest again, that's often when the biggest opportunities emerge. It's no coincidence that some of the greatest investors in history made their biggest moves when everyone else was running for the exits. But even when opportunities arise, risk management is crucial. Never invest money you can't afford to leave in the market for several years. Recessions can last longer than expected, and the recovery may be slow. Having a strong financial foundation, enough cash reserves to cover living expenses, ensures that you won't be forced to sell at a loss if the market takes longer to rebound. The best approach during a recession is to be patient, strategic, and disciplined. Instead of reacting emotionally to price swings, focus on the long-term fundamentals. The companies that survive and thrive during downturns are often the ones that lead the next bull market. The assets that are deeply undervalued today could be the biggest wealth builders over the next decade. Recessions are not something to fear, they are rare windows of opportunity. Those who stay prepared, educate themselves, and take action when others hesitate often come out ahead. The question is, will you be one of them?